Portfolio Builder members, welcome to our Monday webinar. We are going to start off by talking about the profits we generated over the weekend. Then I'll hit up all the popular news that is pressing for the week, and then go into a little demo of how to use the platform. So let's start off by just taking a look at Friday's profits. If you look up top in this last trading price, you can see when we wrote the covered call on Friday, SPY was trading at 290.14, and when we covered it today, it was at 289.82. We were able to collect a credit of 83 cents and buy it back today for 33 cents. And so the end profit on the covered call was a $50 profit per contract. And the unrealized loss on the SPY at the moment we wrote it was negative 32 cents. So the net profit was 18 if you look at the underlying. But in general, we're not really worried about what the underlying asset's doing. It's kind of like you've bought a nice apartment in New York City. It's part of a bigger ecosystem, and now we're using the Airbnb app to write a covered call every Monday, Wednesday, Friday to generate income. But even if we look at the small return with the underlying, and we look at how that compounds, if you do it 156 times a year, that's 3 times a week, it generates a pretty healthy return of 9%. And if you use Robinhood app, they'll actually let you leverage your account. So if you have $30,000 in your portfolio, you can actually trade as if you have $60,000. So instead of having a 9.8% conservative return, you might have a 18% return. And now, if we do look at the profits of doing this based on the $50 profit, because that's really the profit we're realizing. So if we actually make the $50 profit, that's a 0.17% return. If we do that 156 times, that generates a $9,100 profit, which is a 30% return. Use the leverage, now you're sitting on a 60% return just from the covered call. And so let's talk about so let's go ahead and look at what will happen in the stock market to get the same kind of return. So I've really scrunched down the SPY here. But you got to ask yourself, do you want to gamble that the SPY is going to travel from 290 up to 320 or even up to 360 this year in order to get the same return? So we're going to have one of the most epic bull rallies ever. Or would you rather just write a covered call and get the guaranteed return? And so when you look at it that way, it makes a lot more sense to let speculators bet on how fast the stock market will go up, and then we can focus ourselves on just generating a consistent return and protecting our capital. Because this strategy makes the same return whether the market's going up, flat, or down. So let's go ahead and jump into part of our presentation, and then we'll get back to our track record and demonstrate how to use it. Okay, so Trump had a funny tweet about a day ago, 23 hours ago. If the Fed had done its job properly, which it has not, the stock market would be up another 5,000 to 10,000 additional points, and GDP would have been well over 4% instead of 3%. With almost no inflation, quantitative tightening was a killer. Should have done the exact opposite. And we have more work. The China trade deal is having a little bit of a stall out, which we'll get into in a minute. And the Feds continue to forecast no rate hikes. Kudlow wants to disrupt the Fed with the new nominations. And U.S. Treasury Secretary Mnuchin says there's no signs of a potential recession in 2020. We also had Jamie Dimon coming out saying it may not even be until 2021 now. The GDP of America is greatly outperforming the rest of the world right now. Another bullish signal for our SPY strategy. In terms of key events this week, we have the China GDP, which is expected to be a little less than it was, but still healthy at 6.3%. It's only down 10 basis points. We got US retail sales and lots of earnings coming out from mostly banks. Also, we can see the Fed's central bank is a lot stronger than its peers. We have China printing out trillions of dollars right now, trying to support its economy. The ECB continues to have a very high ratio of debt relative to GDP. And meanwhile, the US was able to get rid of a lot of the balance sheet, not all of it, but more than all the major central banks. And so the next firing squad is going to be aiming probably at the UK to try to improve trade deals with Europe. You can see Goldman Sachs revenue is strong, but still starting to slow down. So this is the reason the central banks are being so dovish right now, is that although America seems to be strong, the rest of the world has a clear slowdown. And so the message from the Fed right now is they're just going to do nothing. Now they're actually saying they may not raise rates till fall of 2020. Dollars remaining strong, and we can actually see a huge speculative push betting on the dollar against other currencies. The Kospi is a good leading indicator, South Korea's stock market, and typically can help predict bigger markets ahead of time. And so it's pointing straight up right now. The treasury rates are super cheap, so not competing with stocks at this point in time. And again, this is the picture that we need to think about. If you had invested in the stock market in the 60s, you didn't make your money back until 1995. And so that's the big concern. Can you afford to buy and hold and just hope the stock market goes up forever? Or do you need a strategy that protects your capital and can make a profit in various conditions, such as flat or down? We still have record buybacks, which continue to escalate. And this is a key reason the stock market has been traveling higher this year. And in a moment, we'll look at our advanced class, the diamond level membership, and the specific stocks in that portfolio are actually the top stock buyback purchasers. US tech giants spent 55% more on share repurchases in 2018 than 2017. So we can see the tax cuts are dramatically helping the stock market because of this phenomena. And here's an article from Seeking Alpha. We have looked at this fellow's analysis last week. And so his basic outlook is all the indicators are pointing towards slightly up at this point, but the long-term picture is that perhaps we have a year or two or more at most before we should see a recession. So people are worried that we're hitting a head and shoulders pattern. I'm not big on technical analysis, but there are enough people out there that follow it that it can become a self-fulfilling prophecy. Here's a look at unemployment claims, and you can see it always seems to tick up right before a recession, and so far it is still traveling lower, so that is why everyone thinks we are at least a year away from some sort of stock crash. Another leading indicator would be motor vehicle retail sales on heavyweight trucks, which has to do with transportation and construction. And you can see there's a sharp crash in that leading into the last 3 recessions. So far, still strong. Another indicator, the value of manufacturers' new orders for consumer goods, still strong, typically starts to pull back leading into a recession. Financial conditions are at very, very low levels, so there's no stress in terms of credit. And the retail sales had a little bit of a slump in the beginning of the year, especially in February, but it's still very strong, and we will get a new print on that this week, so it'll be important to watch. In terms of valuations, we're starting to get pricey, no matter which valuation metric you like to look. However, predicting the stock market based on valuations is proven to be an unfruitful strategy. So this particular person's prediction is that the problem is that right now, as the economy reaches as good as it gets, that creates risk to the downside. And another interesting fact, on any random day, probability of the stock market, the S&P 500 being higher, is anywhere from 56% to 81%, which is why this strategy is so strong. We can really trust the underlying asset will not disappear. It represents the top 500 companies in America, and we're letting the gamblers bet how high it will go up in a short period of time while we get to play the house. Over in China, they are having some serious problems. It's hard to trust some of the data that comes out of China, obviously. But the Q1 imports from the US were down 31%, down 13% from South Korea, down 7% from Japan. So China is definitely slowing down, and that's why they've printed some $2 trillion into their economy so far this year. So it's interesting to see what's really happening with that. In terms of some other bad news, the crisis in Turkey is really escalating. First, they were trying to manipulate their currency ahead of elections, which could potentially be why we've seen so much capital flow into Bitcoin. I think the people that live there are getting very worried about the value of their currency. And you can see the Turkish unemployment rate is now at 15%. Turkey's youth unemployment is skyrocketing to 26%. And you can see the conversion of dollars into the lira has just been getting worse and worse, from 4-to-1 to up to 6-to-1 today. So that's a 50% devaluation in the value of Turkey's currency, and most of their debt is denominated in dollars. So that's it's a bad sign for them. World trade volume ticking back up. The crash was scaring the IMF in particular. And then the Baltic Dry Index, another good shipping indicator. It had crashed towards the end of 2018, which coincided with the Christmas massacre, and now it's picking back up. Trading volume is dying down as we get towards high prices in the stock market. So it'll be interesting to see if we can really break into new highs, or if we're going to just bounce around here, perhaps for the rest of the year. World Economic Data Surprise Index is nothing but negative, which is again why the central banks have been so concerned about the global growth picture and keeping rates low. Meanwhile, Washington backtracks on enforcement progress, caves on demands, Beijing scraps industrial subsidies. So, we've heard so many stories about the China deal. It's going great, it's going bad, it's going great, it's going bad. There's a tough deadline by March. There was never a deadline. So this is something we're definitely watching carefully. However, I expect with the election in 2020, I don't think this is going to get much more riled up until after that's all done. Meanwhile, there's sanctions on North Korea that are causing some pain. And Kim Jong-un says he is giving Trump until the year end to become more flexible. Now, the U.S. is most likely delaying that deal until a China deal is accomplished. So this would be Wikipedia history book stuff if we can get North Korea to denuclearize and create a legitimate trade deal with China. So this could be huge for the stock market and really a piece of history. So that explains why it's taking so much time. And it's always comical to read Trump's language. I agree with Kim Jong-un of North Korea that our personal relationship remains very good. Perhaps the term excellent would be even more accurate, and that a third summit would be good, and that we fully understand where we each stand. So hopefully that doesn't blow up in our face. That's the end of the quick news reel. Today we are focusing on Dean for who you can call in to save money on your membership. 505-322-7515. Let me jump over to our trade alert today. Today's trailer was right at the money, 290 strike, expiring April 17th, collecting $86 per contract. And now I'm going to hop over to the track record. We did issue a new spreadsheet to everyone, and you can see there's been some slight changes, namely in these three spots. So we now have the TBT as a buy and hold position. So any extra cash that you can't afford to get 100 shares of the SPY with will flow into this TBT ETF. My current setting is 90% targeting the SPY and 10% in the TBT. And we've added TECS and VXXB as a way to hedge against downside risk. Now we're not going to try to jump into that until we actually see the market deteriorating, because that's usually a losing proposition. If you remember the odds I just gave you, even in the short term, betting down has bad odds. In the long term, it has really bad odds. So we really want to just play the momentum whenever we jump into a bearish set of ETFs such as those. Now, a quick teaser for our more advanced class. This is not given away during the free trial. However, if you do upgrade from your free trial to the basic membership, we have a free bonus this week where you get 90 days in our Diamond program free when you do upgrade to our basic program. This portfolio is outperforming the SPY, and it only trades once a week. It does require more capital, $150,000 to build this exact portfolio, but there's a few advantages. Number one, these are the companies that have the most profit and the most stable businesses to do the covered call strategy on, and they are buying the most shares back with their profits. So these are the leaders in the stock buyback, and that's why they are outperforming the S&P 500. Plus, because we're now writing a covered call on the individual securities, we can aim a little bit more accurately on each individual security. So, for example, the option market's been very good at predicting individual moves, such as Facebook having a nice rally, and other stocks as well. So we'll cover this more tomorrow for our Diamond members, but that's just a quick tease on that. Thursday is our emerging markets class, which is about tied with the SPY strategy at this moment. This helps you take some of your capital and diversify it outside of the American market into China and its key trading partners, as well as some access to the precious metals. So this class will be on Thursday. And again, if you do upgrade from your free trial to the basic program, you'll also get to enjoy this class free for 90 days as a bonus as well. All right, that wraps up our presentation for today. Let me go ahead and turn on some audio here. We got 13 people on right now. A lot of normal audience, but we do have some new folks in here.
Yes, that'll be great. Thank you very much.
All right, guys, how are you doing out there? Hey, John, how's it going?
Good.
Mike's out there. I think he's got his audio muted. He might have the twins with him. Mark is out there. I can hear his audio. What questions do you guys have today?
No, that's fine. Maybe it's just this side. Hold on.
Okay, I took the bag out and I left it on the side so that I could close it and it didn't like fall in there. But then
Gress, is that you speaking? How's it going out there, Paul? I've noticed you've been busy playing with the platform over the weekend. You getting it all to work all right? Bill, how are you doing? I just got your mic unmuted as well.
Good, thanks. I think I'm doing about like you guys are on this program.
Great. So you're up and rolling now, huh?
Yes. So today, I think apart from commissions, I was up $480 for the Monday through Friday. Excuse me, for the Friday to Monday.
Oh, okay. So you're rolling about 10 contracts then, huh?
Yes.
Great.
Very nice, Bill.
Now, have you considered? Well, yeah, that's a pretty big portfolio. Who are you using for your broker?
TD Ameritrade.
Okay. Yeah, that's a very long-standing company, but perhaps some of the worst commissions. So, but you know, a lot of people do negotiate pretty good deals. Have you already negotiated a deal with them to have better than advertised commissions?
Yes, I'm actually doing one contract at Schwab and using them as my basis. And the TD Ameritrade people have said, okay, we'll meet the Schwab numbers.
Well, now you need to go set up an account at Robinhood and tell them to match that because they have no commissions.
Yeah, well, I've heard your comments on this. I've looked a little bit at Robinhood, and I think it's just a matter of time, maybe another couple of weeks, as I settle into understanding how this works, and then switch some of the cash over to Robinhood.
Sure. Yeah, and then the nice thing about Robinhood, I mean, all brokers do this, but you can get a one-to-one margin. So you could double your buying power and double the returns with this. They are charging 5% a year, but if we're pulling 15 to 30% return, it makes a lot of sense, considering how conservative this strategy really is.
Roger that.
Hey, Bill, this is Dean Gallagher. Just wanted to tell you congratulations. That's a fantastic profit in 5 to 10 minutes of work total.
Yeah, really, totally agree. And if I had a question, it is as you go through the presentation, I sometimes see some things that are really interesting to me, and I'm trying to keep up with you as far as the various elements that you've spoken about as background. For instance, there was somebody on Seeking Alpha, Fred.com, Schiller PE ratio. Those things can help build confidence in moving forward with the program. And as you pointed out a number of times, having the downside risk on the underlying is perhaps not so great when we can consider that this is a little bit like a New York apartment. Values will fluctuate, but you're earning every week.
Hey, you're pulling the words right out of my mouth. That's exactly right. And but sure, there is definitely some risks, and that's why we don't want to be the guy who looks at his trading account once every 3 months and wakes up and all of a sudden he's down 30%. So because we're watching it Monday, Wednesday, Friday, we can really protect the capital and just move that strike price around. I got a question from Mark. Do we want margin with this type of investing? Yeah, so unlike with cryptocurrency, the movement of the S&P 500 hardly goes more or less than 1% in the time period we're at risk with our covered call. And I would say, even though we normally don't trade on a Tuesday, Thursday, if you guys do email us your telephone number, your cell phone, Let's say it did drop a little bit between a Monday and a Wednesday. We can roll over that position on the covered call for a very high profit and increase the protection just by moving that strike down. So yeah, if you can get a good deal on margin and it's worth it to you to double your income, it makes sense to do that. So I'm not sure what they charge for interest at TD Ameritrade, but with Robinhood, you can get 1-to-1 leverage for 5% a year. And it's only on the days you're actually using it, which would be 100% of the time outside of being assigned. So. Are you using any margin over there at Ameritrade, Bill?
No, I've been doing this for about a month. Last week was a little bit even nicer than this one. But as I get my hands around this, especially moving to Robinhood, it makes a lot of sense to go ahead and use some borrowed funds.
Yeah, as long as you're, really maintaining it and doing the Monday, Wednesday, Friday. Well, that's really great. Now, I do want to say testimonials, we do have to disclaim, even though this is a very liquid product, extremely liquid, everybody's going to have their own result. So results are not necessarily typical. But with that said, that was the whole point of this product. In 10 years of doing this, my experience was finding the smartest, greatest minds who all wanted to beat the market. And in order to beat the market, they were just whipping out trades here and there. Nobody could follow it. No one knew what to do with them. They didn't know how much capital to put into each trade. They couldn't get the same prices. They weren't able to get the same result as the advisory service. And so most of these were in a bull market, so most did well, at least in their accounts, but could the person following the product get the same result? And usually not. Now this product, you know what's going to happen. Monday, Wednesday, Friday, 11 Eastern, you get the trade. One click to cover your position, another click to open the new, 3 clicks to put in your new order, and you're done. The webinar is really optional, just to help you understand what's going on and get confidence, and perhaps have a little bit of a view of what's coming up towards us. But I got a new question for Mark. I think this melt up is going to stay for the rest of the year. Do we not take some of these trades? Wait. Oh, all right. So Mark's saying he wants to, he thinks the stock market will go up forever. No, I'm just kidding. Let's pull up that chart. So yeah, if you want to beat our return, Mark, even on a conservative, very conservative, we just get the 10% return. You got to ask yourself, you think the SPY is going to go to 330 by the end of the year? Let's look at what that looks like. There's not even any analyst that's predicting that, much less, yeah, I'd be highly surprised if we got to 330 by the end of the year. So to get 10% profit, it would be 320, my bad. Now we can make a lot more than that because, if we looked at the return on the $50 3 times a week, it was 3 times the 10% return. But let's just say 10% return on the S&P 500. It goes to 320 by the end of the year from this point. I highly doubt that's going to happen, but if it did, it still would be the same return as us doing the in-the-money covered call. But what if the market doesn't do that? What if it just bounces around for the rest of the year while we wait to see if a China deal ever happens, while we wait to see if the rest of the world's growth picks up? We're going to make the same boring return playing the house, selling the covered call, really no matter what happens. And actually, as the volatility goes up, right now, the return we're making on the covered call is really relatively bad because the volatility index has been crashing all year. So as the volatility goes up, the cost to buy options increases. So we'll be able to actually enjoy better and better returns as the volatility picks back up. So I'd be highly suspect that the stock market will go up forever. In fact, I'm quite certain we'll see some volatility by the summer. And yeah, Paul, we'll get you on that diamond for your 90-day bonus for sure. Paul ordered recently. Want to know if he can get that 90-day trial? I'll tell Ryan right now. So Mark says the last 12 to 18 months of a melt up could be 30%. But yeah, that's how much we make just with the $50. So let's look at that. If I take 100 shares of the SPY, which is approximately $28,980, and I pull $50 credit profit from the covered call 3 times a week, that's a 0.17 or 17 basis point return. And if we compound that 156 times, that's 52 weeks times 3 times. That's a $9,100 profit. That's a 30% return. So you tell me, would you rather make a safe 30% return with a little work for 2 minutes 3 times a week and even use some leverage, double that return, use 1-to-1 leverage, or you want to gamble that the stock market will go up? And the more important thing is we're not looking at what we're going to make just this year, how much we're going to make in the next decade of using this. You know, if I compound this return for 10 years, what do we make? You make a 1,300% return. So it really adds up. If you don't need to spend these profits, you can do this over and over and over and over and over again and just keep adding it to your portfolio. In 10 years, this strategy is very highly effective. And it's only possible because you guys have small trading accounts. You can't do this with $100 million. All the big banks can't do this for their clients because they have too much money they're managing. And so we have, at the end of the day, the best security in the world, really by all metrics. You know, America's companies are outperforming all other stock markets ever. They're making more profit, and at this point, we're really the last strong economy right now. Now, sure, all the big banks are betting on emerging markets in China for the next 3 decades, which is fine. But for retirement income, we're not trying to catch growth. We're trying to find a stable product and then just play the house, sell the covered call, and take the profits. Now, Mark's saying I'm just playing the devil's advocate, and that's great. No, that was good food for thought, and it just goes to show how powerful this strategy is. Okay, so Paul has a question. I bought my first SPY today, but it was already at 259.16. Did you? Oh, 289.16. Would a 289 call work as well? Yeah. So we wrote right at the money, and when I did it was at 290. So yeah, 289. If it's trading right there is showing me that you understand the strategy, and you got it. So that's the idea. We're just going for that very juicy in the money covered call today. It's one of those strategies that there's not a whole lot to talk about. You just do it over and over and over and over again. And the main concern is trying to avoid the number one rule: don't lose money. And that is the key thing. Let's take a look at some of these inverse ETFs, because I know a lot of people, and the TBT. Let's talk about why we want to own the TBT and when we might buy the TECS and the VXXB. So prior to this week, we were going to hedge our portfolio with an in-the-money call option on the VIX and potentially buy put options on the QQQ. But I've explained to everyone, hey, good job, Paul. You got $121 instead of the 86 we pulled on the contract. So in order to make this product even easier, buying options on the long side is a very tough proposition. And most people lose money doing it. And we looked at the odds. The odds, no matter how you skin the cat, are against your favor when you bet down. And perhaps the only time that's not true is when the market is already heading down. And that's because the stock market has become a very momentum-based system with artificial intelligence trading it and not even humans. So while a human might say, oh, that's cheap, the computer says we can push it lower because we have $1 trillion behind us, and we're going to push it until it stops. So our strategy to make your life easier now utilizes these two ETFs. Now they do, in fact, have the same problem that they're going to lose value day after day, just like a long call option would. But because they are traded as a security, an ETF, it makes your job to maintain the right exposure much easier. And so if we do get some sort of panic, TEX is the 3 times leveraged technology ETF. If we zoom in on that one, from October to December during the last crash, this rallied from 20 to 35. So we can catch a pretty nice profit with a part of our portfolio by buying this ETF. Now it's down to 1383. So very cheap on this one. But again, we know the whole stock market is leveraged to go up. And it only goes down when we get a panic. And in the same strategy, the VXXB gives us that same sort of opportunity. This one actually had a better return during that crash last year, going from 26 to 51. So at most, between 10 to 30% of our portfolio would rotate into the hedge, and it would happen as we're continuing to write the covered call on the SPY. So if we're wrong, hopefully we're able to tread water and lose the same amount as we're collecting on the credit. Okay, and as the SPY goes down, if we're writing our covered call below the trading price, we still make the same return. So let's look at that one more time. This is what I call the risk-free way to bet the stock market will go down, which we're not doing on today's trade, but let's look at this particular. Let's say we wanted to buy $5 of protection between now and Wednesday. And right now, volatility is so low that these option premiums are cheap. If you want to buy a put option or a call option right now, it's relatively cheaper today than it has been all year. And that trend is continuing. Okay, so let me pull up this ticket. Okay, so right now the SPY trades at, let's just round it up to 290. It's really at 289.85. And if we wanted to buy $5 of protection, we would sell the 285 strike. And so why would we do that? Well, because the value of that call option will lose value at a faster rate than the SPY will go down. So if the SPY trades between 290 and 285 on Wednesday, we're collecting the time premium that is part of the option value. So we don't really care what the stock market's doing with this strategy. If the market's trading lower, we're going to write the strike lower. If the market's trading higher, we'll most likely be trading the momentum higher. And so this gives us a risk-free way. If we're wrong, and we wrote this 285 strike, and the stock market flew up between now and Wednesday, we're basically getting the spread. So that's 12 cents right there. We'd make 12 bucks if we're wrong. But if the market goes flat or down, we're making more. We're making the profit on the time premium that's been lost on the call option we sold. Now, if we try to hedge with something like this, you can see it is losing value very rapidly. So again, we're not going to buy a risky hedge until the market is already trending lower. And again, it's a quick in and out, and could represent a nice profit in a very short period of time for us. Any other last questions out there? And Paul will make sure to get you your bonus for the next 90 days. And again, if anybody does want to join Paul and the rest of our team tomorrow, just upgrade your free trial. Call Dean, 505-322-7515. He does have special pricing. And give everybody one last chance to ask questions before we wrap today's webinar up. All right, gentlemen. Well, we hit 12 people today. Friday we had 18. Our group is growing. Really appreciate everybody's time. And I look forward to having you all together next Wednesday. Thanks again.